Hey everybody, it's Mr. Wagstaff. Cool stuff to talk about today. So today we're continuing our unit here on taxation and economic and personal finance. This is our 5th unit. So today we're going to talk about some federal taxes. The last lesson we talked about all the taxes that gets taken out of your paycheck. I feel like the next few days we need to really go through and talk about why these taxes are taken out and what they're used for and how specifically the government receives these taxes, not just through payroll deductions. So let's go ahead and get started. So today we're talking about paying your federal taxes, how the federal government gets that money, and we're going to talk about what that money is used for, because you're going to pay taxes your whole life. Might as well know why you're paying the taxes and what it's used for. So how does the federal government get your taxes? Well, you have to pay them, and there is an actual time period in which you have to pay the federal government. It's called tax season, which is between January 1st of the year and usually April 15th. April 15th is usually the date. If that falls on a weekend, they'll usually move it back a couple of days. I think in 2023 it's April 18th. But you have that time period to file your taxes. Now, as we talked about in the last lesson, your taxes have been deducted all year. So you shouldn't, in large part, if you just have a normal, simple job where taxes are taken out, you shouldn't really have to pay anything. You just have to do paperwork because you've already paid them your taxes. And a lot of times you'll actually get money back if they took out too much taxes over the previous year. So a lot of times it's a benefit to do your taxes because you'll actually get some money back. So when you pay your taxes, and we will talk about this in depth on the last lesson of this unit on like the forms and things and more the complicated aspect of paying your taxes. But here you're going to pay your taxes to a a division of the government called the Internal Revenue Service, the IRS. All right. So during tax season, it's tax time. You get all your stuff together and you'll pay it. And you will explain to them how much you've had taken out, how much you owe, and you have your data to back it up. The way this works, all right, and we're going to talk about this more when we get into the last lesson of this unit. When you get a job, you'll fill out something called a W-4, which basically says, hey, here's like my typical life situation. And here's how much money you should take out each month so I don't have to owe anything at the end of the year. And then at the end of the year, they give you, meaning your business, whoever you work for, gives you something called a W-2, which tells you how much money you made that year and how much taxes they kept out and have already paid on your behalf. So these two things are very important when it's tax season, which is really, again, between January 1st and April 15th of every year, to officially turn those into the government and say, I paid all my taxes and I might even be getting a refund here. So the question here is, what is tax season and when is it? So it's called tax season. It's obviously it's not really a season, but it's just a time period. So explain what is supposed to be done during tax season and what when that is. So pause me, answer that completely. We're moving on. All right, so how does the federal government get your money? All right, we talked about in the last lesson, income tax gets taken out of your check immediately. So how much money are you supposed to pay for your income tax? These are usually calculated due to your W-4, and again, we'll talk about W-4, W-2s, W-9s, all these different form numbers here in the 5th lesson. But the more money you make, the progressively higher taxes that you pay on each bracket as you move up. They're called federal tax brackets. The more money you make, the higher percentage you pay. Like if you made $15,000, you pay 10%. Now, the tax brackets change all the time. This is for 2023, is the most recent tax bracket that I can find, because it is 2023. The percentages usually remain the same, but due to inflation, those numbers usually increase over time. But if you made $15,000, you're only paying 10% in taxes. If you made over, $500,000, any money over $500,000 will be taxed at 37%. However, even that person that might make $1 billion a year or something like, some insane amount, their first $15,000 is still taxed at 10%. So tax brackets, it's a sliding scale of the more money you make, the higher percentage of that goes in taxes just to the federal government. So where does your money go? You're paying all this money in taxes. What is it used for? So 70% of the money used by the federal government is what's called mandatory spending, meaning it's already been promised out. Things like Social Security, Medicare, Medicaid, veterans benefits. We have to pay 5% of it is on our loans because we always spend more than we make, and we have to pay off our debt for that as a federal government. And then only 25% is discretionary spending, all right? Which means stuff that we can vary with every year, and that's like defense, education, transportation, health. But the big mamma jammas for our budget, for the money that's spent, there's a lot like Social Security, which we're going to talk more about, and Medicare, which is health care for retired people. A huge amount of our federal money goes to that. Also, our military. Our military is exclusively paid for with federal dollars. That's why you'll have a state income tax too that we'll talk about tomorrow, but the military is paid with federal dollars. To show you how much money we spend on the military to stay safe, as opposed to the other countries, here's where it is. This is global military spending. In 2021, the entire world combined spent $2.1 trillion. America spent almost a third of that just on America. We spent $801 billion with a B, $801 billion on the military in 2021. That is more than like the next 15 countries combined. And I want to say, I have a quick glance here, like 13 of those 15 countries are our allies. So we spend a lot more money on the military than the rest of the world does. So that is in large part why other countries can do things like have universal health care, because they're not spending their tax base on the military the same way the United States is, which is a whole nother geopolitical conversation for a whole different course. But the question here is, explain what a tax bracket is. So we talked about that. So pause me, answer that completely. We're moving on. All right, so Social Security taxes. Payroll tax is a smaller thing. If you own a business, it's a little bit different, but I want to spend some time here talking about Social Security taxes, because you'll see this get taken out of your paycheck too. What is Social Security? So, Social Security is a large amount of money that gets taken out of your paycheck, in which the idea, all right, super simple, is that when you're 65 years old, you can start, Social Security starts paying you, and you should in theory be able to retire. However, there's a couple interesting aspects to that. Number one, say you average and you make $142,000 a year your whole life. Social Security payout, if you want to retire from that job at 65, is $34,000. That's like $110,000 difference in the amount of money you've made your whole life and how much Social Security will pay out. So it's almost impossible to live exclusively off Social Security. Here's another one that catches people off guard and they don't realize it until they're older. So that $34,000, when you're older and you start receiving Social Security, that $34,000, that is also taxed as income. So even though it is a tax benefit for older people, it is actually taxed itself. So you have to pay taxes on your Social Security income as you're receiving it. Another huge important part of Social Security is as you pay it, and you see these large numbers get taken out of your paycheck every pay period, that is not going into a specific little box for you. That money is coming out of your paycheck today and paying an elderly person today. There is no savings of Social Security. So the current working people, they are contributing to Social Security of current older retired people. Because of that, there is a chance that not enough people will be working when we retire, and Social Security could, in theory, not even be there, even though we paid into it our whole lives. So, fun nugget there. But the question here is, what is the purpose of Social Security taxes? So pause me, answer that completely. We're moving on. So here's some taxes that don't get taken out of your paychecks. We'll start with federal corporate taxes. Large corporations, all right, that make like large amounts of profit, they also have to pay a tax of the profits that they're making for their entire corporation. However, the corporate tax rate has dropped over time, and you can see here as a share of GDP, which is how the entire economy is gauged. Back in the early 1950s, almost 6% of the GDP of America was made up of corporate taxes. Now it's at about 1%. Very small percentage of our GDP is made up of corporate taxes, and then that's when you get the ideology of like, these are big corporations that make gazillions of dollars a year. They can afford to pay more taxes for the betterment of society. And then the other side is, these massive corporations are employing a ton of people. The whole goal of a corporation is to make more money. So if you take that tax money from them, they're not going to have the money to create more infrastructure and create more jobs. So therefore, you shouldn't tax them as much. And there are people that get into these arguments that are firmly on one side or the other. But the corporate tax rate has come down quite a bit since the 1950s. Another way, and obviously you are not a corporation, so you don't pay corporate taxes unless you end up owning a corporation. Then you have a team of people to do that for you. So let's talk about another way that the federal government gets money that does not come out of your paycheck. That is excise taxes. So excise taxes are very specific. Excise taxes are taxes on very specific items, and those taxes get used for something very particularly. Usually in dealing with the section of the economy or the idea or whatever it is that you're taxing. So I'll give you examples here, all right? So we will also, when we talk about state taxes, talk about excise taxes, and we will use a lot of the same examples because things that have an excise tax on them usually have a federal excise tax and a state excise tax, both of them. Here, this is gasoline. Almost every state has a state excise tax, but every state does have a federal excise tax, which is the same, all right? So for every gallon of gas that gets sold in America, all right, 18 cents of that gallon of gas goes to the federal government. Everybody in the country, every time they pump a gallon of gas, 18 cents goes to the federal government. Excise means it is a tax on a specific thing, in this case, gasoline. So because the government takes that money from gasoline and it's an excise tax, they have a specific role for it. All right, so here is what the federal government does with the excise taxes. So the federal government is responsible for the interstate highway system. So where I'm at, Interstate 40 runs right by my school. All right, Interstate 40, which runs from Wilmington, North Carolina, all the way to California, that is a federal interstate highway paid for by federal money. The 18 cents that is taken off of every gallon of gas is used to make sure that road stays in good order. It is used for a very specific thing dealing with transportation and infrastructure. Bridges. The federal government really wants to make sure bridges are done right. So when it comes time to build a bridge, the federal government is in charge of building bridges. So bridges are wildly expensive. So also, the excise taxes that are paid from gasoline also go to helping fund build these massive bridges, because you need bridges to be done right and pass all of the inspections and everything that will happen with the government infrastructure. Usually not super efficient, usually not super fast to build a bridge, but generally speaking, bridges are done correctly because there's so much red tape, and that is paid for by excise taxes paid for by gasoline. Let's give another example of this. Cigarettes. The government imposes a pretty steep, it's almost $1 now, I believe. It's almost $1 now in federal excise tax that is added to every packet of cigarettes. So why? There's a couple reasons excise taxes. In this case, by increasing the cost of cigarettes, you're trying to convince people to not smoke because it's very, very damaging, hurts a lot of parts of the economy, not to mention the healthcare cost is what is so devastating with lung cancer and things like that. So the people that don't quit from that, they are making money off of that. So what do? The CDC, which is run by the federal government, put out a huge marketing concept using the money from this excise tax to try to prevent people or encourage people to quit or to not start, using specific stories from people who had lost their legs, lost their voice, really pointing out the humanity of the negativity that cigarettes can influence on you. And it does seem to have had some positive effect. So excise taxes are used for very specific individual situations. They are taxed on, like gasoline used for roads, makes sense. The tax on cigarettes is for health care and trying to encourage people to stop quitting. They are very focused taxes for very specific issues needed. So the question here is, what is the primary purpose of excise taxes, especially at the federal level? So pause me, answer that completely. We're moving on. All right. Now we are at estate and capital gains taxes. So we had mentioned estate taxes and how some states don't charge state taxes, or some states don't charge estate taxes, but that's not the case on the federal government. The federal government absolutely charges estate taxes, meaning if somebody passes away and leaves you an inheritance, a large chunk of that is going to get taxed and taken by the federal government. So if it is up to $10,000, 18%. Somebody leaves you $5,000, 18% of that goes to the federal government. The higher amount that gets left to you, the more you have to pay to the government. If somebody leaves you over $1 million, all right, you have to pay over 40% of that, or 40% of that amount to the federal government. This is why, say your parents, somebody, I don't know, they have your rich uncle has a house for $1 million, passes away, leaves you the house for $1 million. That house is assessed at $1 million. Sure, you get to keep it, but you also have to pay $400,000 in taxes to keep it. Basically like buying this $1 million house for $400,000. That is why, even though people can inherit homes, a lot of times they turn around and sell them, and they have to give up 40% of that in estate taxes. So estate taxes are very heavily taxed by the federal government, which you can imagine this can sometimes be quite a heated argument when it comes up with the idea of renewing it or getting away from estate taxes, of taking people, taxing people's gifts to other people in large amounts, even though those people had already paid taxes and that their whole life on it. Another way the government gets taxes that is not taken out of your paycheck is capital gains tax. So capital gains tax is you made an investment and you made a profit off of it. That profit is taxable income. But it gets really slippery here. This is where corporations and things, they hire teams of lawyers to pay the smallest possible amount of taxes because it's not real cut and dried here. So say you buy a house for $200,000 and you sell it for $250,000. Now, since you bought it for $200,000 and you sold it for $250,000, the only part of that is considered capital gains is the $50,000. because you're not taxing all 250 because you did buy it for 200, so you get that money back, but you get taxed on that $50,000. Now, depending on what you buy, whether it's stocks, whether it's houses, whether it's fancy vases here, really depends on how much taxes that you pay, and this is where it gets very fluid, because there's a lot of ways of, like in real estate, especially with houses, there's a lot of loopholes here that you can work through and have a very small percentage of taxes paying as opposed to other types of capital gains. So there's not a real cut and dried way of determining how much is capital gains tax. So, of all the things that we talk about what the federal government does pay for, one of the things it does not pay for, just throwing this in here randomly, is education. Federal government, while they deal with IEPs and IDEA, the Individuals with Disabilities in Education Act, they do not fund schools. That is almost exclusively state. But the government does do the federal government does do some stuff with education, but the state government is exclusively in charge of paying for education. So the question here is, what is the purpose of capital gains taxes? So pause me, answer that completely, and that's what I got for you guys today. See y'all tomorrow.